QuickBooks Online 2025. Generate reports after entering beginning balances. Get ready and some coffee because we're learning how to save time with QuickBooks Online 2025. Here we are in our QuickBooks Online Get Great Guitars 2025 project file we set up in a prior presentation. Continuing here, laying down the foundation, similar to putting in place the infrastructure in a city on which we can start building the building blocks of our accounting system, being, of course, the double entry accounting system itself, entering transactions with the help and use of forms found under the plus or new button, broken out by cycle. The infrastructure, the foundational items can be found typically under the cog, under the lists, primary lists being the chart of accounts and the product and services list. In prior presentations, we imagined that we had these beginning balances from the prior accounting system that we printed as of the end of the prior accounting system, the cutoff date being 12/31 of 2024, so that we can then start the new accounting system data input as of January 2025. As we enter this information, we are entering the chart of accounts or listing those accounts that we want to make sure that we're going to be using. And as we entered this information, we entered some of those foundational list items, such as the products and services. The strategy we took for entering this was not just one big journal entry, but rather we entered each account one at a time in order to be able to take on the added needs for each account, such as subledgers, the other side of the transaction going to the equity account in some way, shape, or form, either to opening balance equity, to retained earnings, or to the income statement, which rolls into retained earnings on the balance sheet. Then we cleaned up the equity section to put everything in one account, which we're now going to be called owner's equity, because we're going to imagine we are a sole proprietorship. Now that we've done this and we haven't even entered any transactions yet, we will have our financial statement with these beginning balances. Let's open up those financial statements, drill down on them in a bit more detail, understanding then how they have been constructed thus far. And then on top of those financial statements, we will start to do data input for a few months of data input and see how that data input then impacts the end structure, the buildings that we are now building on top of the infrastructure, which is this chart of accounts that we set up, as well as the products and services we set up. So let's go back on over here. Let's open up the major financial statements over here. So we're going to go to the reports on the left-hand side. We're in the standard reports. We have the favorites, balance sheet, and income statement. Those are always our favorite reports. The profit and loss or income statement, not going to have much in it yet, because we haven't entered any new data for the performance in the current period. Let's right-click on the balance sheet, open up a link in a new tab. Right-click on the profit and loss, open up a link in a new tab. This is going to be the setup we will imagine we're going to have all the time now. The two tabs to the right being our financial statements, the tab to the left being the data input, which we can do and then check the financial statements on the right. Let's go into that balance sheet, close up the hamburger. I'm going to do a 2-year time frame going from 01/01/24 to 12/31/25. And then I want to select the drop down and see this in years, run it to refresh it. So we see 2024 and 25 side by side. Let's go to the tab to the right and repeat the process. Closing up the ham boogie and close it and changing the range. 01/01/24 tab, 12/31/25 tab, selecting the drop down to see it in years, run it to refresh it. Here we only have information in 2024, nothing in 2025. Now, as we entered these beginning balances, remember, we're trying to build those foundational items in such a way that will make it as easy as possible for us to do data input in the future. One of the benefits of starting a new company file, as opposed to try to pull in all the data from the prior company file, is the ability to clean up the lists, clean up things like the chart of accounts, clean up things like the vendor lists, the customer list, for example, possibly the product and service list. So let's go to those lists real quick and think about where we stand with them. So if I go to the first tab and we go to the transactions, we now have and then to the chart of accounts, closing up the chart of accounts. Note that our strategy here was that we used the chart of accounts given to us by QuickBooks when we set up a new company file, which is massive, too many accounts. So it's not going to be customized to any particular industry. They just shotgun all these accounts out there and try to hope that that takes care of every kind of industry. That means that our strategy could either be that we basically delete or make inactive all of the accounts and then create new accounts as we need them. And that would make it as clean as possible going forward, only having those accounts we need, creating the names as they come up. Some people aren't as comfortable with that strategy, however, because they don't feel like they have enough understanding of accounts in order to just start from scratch. And that's why QuickBooks generates all these accounts. So the other strategy that what we are using is to say, okay, as I do the data input, I'm going to do the data input and look for an account that QuickBooks has given us to see if one is appropriate, if it fits my needs. If it does and has the exact same name, great. If it does but doesn't have the exact same name, then I'll edit the account as we saw before. We'll edit it, we'll change the name, and we'll use the account given to us, that making it less likely that we will create an account and assign it to like the wrong account type. We'll set it up incorrectly, which is what a lot of people get scared about. And as we entered the beginning balances, we did that. Now, what we're going to do is we're going to start entering transactions. In practice, oftentimes people enter most of the transactions with the help and use of bank feeds. And as they enter the bank feeds, you're going to have the vendor name if you had electronic transfers, such as Verizon for the telephone company, for example. So you can use the same strategy. For the first month of data input, we look at who we paid, and then we try to assign the proper account from the list, this massive list of accounts that QuickBooks has provided to us. And then after 1 to 2 months of data input, which are going to be more difficult than later months of data input, because we have to assign these accounts out so the system knows where to put them. Otherwise, the system might guess where to put them, and it'll guess wrong sometimes. It'll be ugly. After we do that for 1 to 2 months, then we can go back into this massive chart of accounts and look for the accounts that we're not using and make them inactive. Why? Because that's going to make it way easier going forward. So that's going to be the process, right? So now I'm going to do the data input for 1 to 2 months. That'll give me an idea of the accounts that we need. I'll use the accounts that are there, change the names if I need to. And then after that time frame, I'm going to go into this massive chart of accounts and clean it up, making inactive any accounts that we are not using. That's the general idea there. If I hit the hamburger, we also note that if I go into the sales tab, the other lists that we set up are the products and services. So in the products and services, we set up these lists when we set up our inventory items. Now, if you don't have any inventory items, then you're gonna be thinking, am I using invoices and sales receipts as my sales forms, or do I have a very simple type of accounting system where I'm just getting paid by YouTube or something, in which case I'm just going to be using a deposit form. If you're using an invoice and sales receipts, you want to think about how you're going to set up your service items to make it as easy as possible to bill. All right, but we basically have set these up because we entered these as we entered our beginning balances for inventory. So that's our infrastructures in place. We've already thought about our payroll and thinking about how we're going to basically deal with the payroll. So we're basically good to go going forward. Let's look at the reports that have been generated thus far. So if I go into the balance sheet, let's kind of think about each of these accounts, how it's been constructed, how it will be continued to be constructed basically going forward, and then how other reports relate to these major reports, remembering that if I look at all the reports that QuickBooks provides us, it's overwhelming. There's a lot of them. But most of the time, we can think about these as the major 2 financial statement reports, all other reports giving us more information about one or multiple line items of these 2 major reports. So let's just kind of go through these one by one. We've got assets, liabilities, and equity. There's our accounting equation. Let's go into the assets here. Within the assets, we have current assets. We've got furniture and fixture. These are the major kind of asset categories that you would typically have in normal financial reporting. Opening up the current assets, we've got the bank accounts, we've got the accounts receivable. In the bank accounts, that's when we're going to have the accounts that connect to the banks or have the capacity to connect to the banks with the bank feeds. If I go into that checking account, what was used to generate this? A deposit form. So that would make sense because we put the beginning balance in place from our prior balance using a deposit form. The checking account is the account that's going to have the most different type of transaction types. And that's because it touches in on all the other cycles. Accounts revenue cycle, accounts receivable cycle, if you want to call it that, the expenses cycle or the payable cycle or the vendor cycle and the payroll cycle all feed through with the checking account. Checking account being the lifeblood of the company. Therefore, it's going to be the most complex account in terms of looking at the detail, the general ledger of it. So we'll see that as we move forward. Let's go back. And so then we have the accounts receivable, which you would only have if you're dealing with invoices, meaning you have to do the work first and then track whether or not someone has paid you. Then you would have the accounts receivable. As we entered the accounts receivable on the books, it created an invoice when we put the beginning balance in place by customer. Remembering the subledger account for accounts receivable breaks out the information not just by date, but by customer so that we can track who we owe. So then if we go into the next one, we have other current assets. These are all other assets that we will basically have in place, most assets being current assets, although you could have long-term assets as well. And then we're going to have property, plants, and equipment. And then this is inventory, noting that inventory, we talked about all the different ways you might deal with inventory, right? You might try to do a very simple inventory if you're doing as-you-go kind of inventory system. You're just holding on to the inventory for a short period of time, in which case you might expense it on a cash-based system rather than putting it on the books as inventory. If you put it on the books as inventory, you might do a periodic inventory system tracking the units outside using a cost of goods sold calculation to adjust the system at least annually for tax return preparation purposes. Or you might be using a perpetual system, which is what we're going to practice using here, it being the most complex to set up. So then we've got the furniture and fixture. This is the fixed asset type of accounts. And the fixed asset type of accounts are those long-term assets. Even small businesses that are on a cash-based system can't get out of dealing with fixed assets, which is an accrual component. So we'll talk more about them going forward. Notice that this account is not in the normal accounting cycle because you don't buy equipment all the time or sell equipment all the time. And therefore, this is not something that we expect to happen all the time. We're not entering transactions to equipment all the time. And then we've got accounts payable. Now we're on the liability side. So we've got current liabilities and then other liabilities. Under the current liabilities, we have the subcategories of accounts payable, which would only be there if you're tracking who you owe in terms of entering bills, which a lot of small businesses do not do because they just pay things as they become due with the help and use of bank feeds, either paying them out of the credit card or the checking account, both being able to be connected to the bank feeds. It's usually larger businesses that are going to track accounts payable more closely for cash flow purposes, for time value of money purposes. And then we've got the credit card account. So the credit card account can be attached to the bank account as well. So you can attach bank feeds to the credit card, which is usually makes them fairly easy to track, although people get a little confused from the credit card as compared to the bank account. We'll talk more about that later and in a whole nother course or section on bank feeds. We've got the loan payable, which will be adjusted periodically when we make payments to the loan. And so we'll see it going forward should be fairly straightforward. It's usually the setting up of the loan payable that we want to make sure that we have a system for. If we do that right, everything else should go forward fairly easily. Although making payments to the loan has two accounts affected, which makes the electronic transfers a bit more complicated. And so we'll talk more about that later. And then we have the equity section. Remembering that the equity section is often the most complicated because it depends on the type of industry or the type of business you are. Are you a sole proprietorship, partnership, or corporation? As we looked at before, I won't go into that in detail again, but just remember that the total equity represents equity that is the amount of the assets that is owed to the owner of the business or owners, right? As a group, if there is a group. If there's only one person, it's straightforward. You only need really one account of equity, but you're possibly going to include draws and possibly investments of the owner as well. And then if it's a partnership, then you got to track all the partners. If there's 20 partners, you got to have 20 partnership accounts, which is kind of crazy. It gets messy and ugly. If it's a corporation, it's easier because all the owners have an equal ownership based on the shares. That's the point of the corporation. But the key point here is no matter how it is structured, net income flows in to the balance sheet. So this net income is QuickBooks showing us that this net income should be part of, in essence, retained earnings. So it puts it in here not as retained earnings in the year it was entered, but rather it adds it as net income, which isn't really an account. And then in the following year, 2025, you can see it rolled in to the owner's equity section, which is kind of like the retained earnings account for our sole proprietor type of business. So that's going to be the idea. On the income statement, we had some transactions that were entered to the income statement because when we added accounts receivable, it made an invoice, which usually dumps the other side into income. And when we entered the accounts payable, it made a bill, which usually is the thing that increases accounts payable, and that usually dumps the other side into the expenses. That's okay because this $5,500 rolled into the equity section as of the end of 2024, and there's nothing in 2025. So we have a clean slate going forward at this point in time to start our new data input in the new accounting system going from 2025 going forward. Any data prior to that is only on the books as of the end of 12/31/2024. Balance sheet accounts, any income statement accounts that you want, performance statements, you will have to go to the prior accounting system to get that information. This obviously is not the performance of 2024. This is just some junk that was entered in order to get our beginning balances correct as we entered one account at a time. So everything's set up going forward. Now, the only thing that we lose in this system, notice the benefits of this are, once again, you can clean everything up from the prior accounting system, which is often something that you really want to do. You want to set up your chart of accounts, clean out the chart of accounts, clean out the customers, clean out the vendors. That's why this system works well if you're changing accounting systems anyways. The downside is I can't really run comparative reports in the same system because I don't have last year's data in this system. Last year's data is in the prior system, which I either kept so I can go back into it if I could, or if I have a subscription model, then maybe I printed all the other information out or saved it so I have it ready. So that's the one thing that's kind of a downside. Going forward, we will be able to do comparative reports going forward, but I can't run comparative reports going backwards because I don't have any of the data prior to 12/31/2024 on the balance sheet. All right, let's take a quick look at some of these other reports just to get an idea of them really quickly. If I go to the reports, just to not be overwhelmed. Now we're building the reports. Most of these other reports will be built as we build the balance sheet. So let's just go over them real quick. Business overview. We've got an audit log. Here's a balance sheet. That's the standard balance sheet. These comparative reports, we'll see that we can make these reports from the standard reports. The summary report is a balance sheet that's just a little bit cleaner of a balance sheet. It has just the summary items. rather than the full balance sheet. So that one is different than a standard balance sheet. Statement of cash flows is the other main financial statement report, but we don't really think about it as on the same level, in my opinion, as the balance sheet and income statement, because if you were to construct a statement of cash flows, which I spent a lot of my accounting CPA firm time doing, you build the balance sheet and income statement first, and then the statement of cash flows. And the statement of cash flows gives you more information about, obviously, on a cash flow basis, whereas the other statements are more on an accrual basis. So you get kind of the best of both worlds with an accrual statement report and then the statement of cash flows, which has the cash flows. Business snapshot, which is kind of some small reports that'll give you I haven't found a whole lot of use for it, but you can check it out. The profit and loss is basically the income statement that we've been opening. Profit and loss by customer breaks it out by customer. You can build that report yourself by opening a standard profit and loss, which we might take a look at that technique later. Profit and loss by store, similar there. If you have class tracking or stores, then you might be able to you can generate those reports usually from a standard profit and loss. Same with the profit and loss by month, profit and loss by tag, similar. Profit and loss comparison, similar. Again, you can build all of these reports, is what I'm saying, by a standard profit and loss. Profit and loss detail, that one might be a little different. Profit and loss percent of total, again, you could build that. We might call that a vertical analysis report from a standard profit and loss. Profit and loss to date comparison, again, you can build that with a standard profit and loss. Project profitability summary and quarterly profit and loss, which I think you can kind of build. You might be able to build these. These might be a little different. But most of these reports, you'll note, are just the normal balance sheet and income statement, which you can then customize doing comparative reports and whatnot, that they just included like a comparative report in here to make it a little bit easier. But if you can do the customization yourself, which we'll touch on a bit here and have another course or section on to get in more detail, you're better off. All right, who owes you? These are all the reports that kind of you would think would be supporting the balance sheet account of the accounts receivable, because it's who owes you, the customers, for work that you did they haven't yet paid you for. So accounts receivable aging detail, collection reports, customer balance summary, customer balance detail. These are all subledgers breaking out the accounts receivable by customer, which you would only have if you have accounts receivable, which you would only have if you're doing an accrual component on the revenue recognition side of things. Let's go to the next one, sales and customers. So what would you expect? You would expect all of these reports to give you more information about the income statement accounts of revenue. So let's take a look at those real quick. Sale by customer type. So you might want to break out the sales not by account, service sales versus income accounts, but by customer type. Estimates. So estimates are a specialized kind of thing that has its own, that doesn't really report something. We'll touch on those later. Customer contact list. That's just a list of contacts. Income by customer summary. So now you're breaking out the income not by account, service income, and inventory income but by customer. So it's a subledger type of report for all of your income or revenue by customer. Customer phone list, just a list of the phone numbers. Sales by customer summary, sales by customer detail, similar here. We're talking about a list of basically revenue and possibly expenses by customer. Deposit detail, so the deposit's a balance sheet thing, but you would expect that most of the deposits are from the customers. Therefore, you can kind of think of it as a sales type of report. Although, again, you can basically make the deposit detail by going into the transaction detail report, which is basically a general ledger account, and sorting by the increases or deposits. Sales by store summary. So now we got the sales by store detail. Estimates by customer. So that's an estimates one again. Estimates is another form we'll touch in on later. Inventory, they dumped the inventory here, even though it's a balance sheet account, but there's no real other place to put it. So they kind of put it in the sales area. So these inventory ones will be supporting the balance sheet account typically of inventory, which you would only have if you're selling inventory, or they would only be useful to you if you're selling inventory. Sales by product. So now we're talking about the revenue account that we're breaking out not by account alone, not by the customer, but by what we sold, the actual product items, by items that we sold, inventory and service item, payment method, physical inventory, and so on. Okay, what about this category? What you owe. All of those reports would give you more information about the accounts payable you would expect. That who do you owe money to? Accounts payable, or the bank for a loan, but that's usually just going to have an amortization table supporting it. So you got an accounts payable aging, subsidiary ledger, breaking out the AP by vendor, who you owe it to. Bills are the things that increase the accounts payable, and then you've got your 1099 reports dealing with the fact that we've got to rat out the small contractors who are not employees and are not incorporated, is the general idea on those. Expenses and vendors, what would we expect this category to be supporting? We would expect them to be supporting all of the expenses. So now we have all the expenses on the income statement. So we've got the check detail. That's a balance sheet report because it's going to be your cash, but all of the checks are the decreases to the cash, which you would expect you would be paying for expenses. Another report that you can kind of generate by making a cash general ledger or transaction detail report and then sorting it, filtering it by outflows. So here's a 1099 report again, purchase by store. So now we've got our purchases, which are usually going to be inventory items, purchases by product. With the things we're buying, usually inventory by the products that we're buying. If we buy inventory, because we wouldn't buy inventory if we were a service company. Open purchase orders. We would only use purchase orders if we had inventory and were able to request the inventory before getting it. Purchase list, transaction list by vendor. So now we've got a list of transactions by vendor, purchases by vendor detail, vendor contact list, expenses by vendor summary. This is the one I was expecting or waiting for. Now we're breaking out all the expenses, not by category, telephone expense, utility expense, and so on, but rather by who we paid, Verizon, the telephone company, Edison, and so on. And then we've got the sales tax, if we have to deal with sales tax reports, employee reports, which of course would be backing up or summarizing the income accounts of payroll expense and payroll taxes, and the balance sheet account of payroll tax liability. And then you've got all of the ones for your accountant. These are usually more summarized reports, and usually they dump them down here because they have to do with debits and credits. So you got the account list. This is redundant. We already saw a balance sheet on the overview. We already saw this one. We already saw this one. These are things that we can recreate. We already saw the cash flow statement of cash flows, store list. Here's the general ledger. That's like the transaction detail report, but it gives you all of the accounts for the transaction detail, meaning if I go into a balance sheet account and I go into like the checking account here, this detail breaking out the transactions by date is what, from a book standpoint, textbook, we would call a general ledger type report. They call it a transaction report, but it breaks out the transactions by date. If I listed all of the accounts breaking out the transaction by date, that's in essence what the general ledger is, which used to be very important before we were able to give all of our books to our accountant to do our taxes and financial statements with the use of online software. So now we can kind of give them that. General ledger report, similar kind of thing, gives us all the transactions by list. Journal, same thing. We give all the transactions in terms of a journal entry. So we're going to have debits and credits involved in that one, giving us a bunch of detail. Recurring transaction list, profit and loss, we already saw that. Redundant, we already saw those up top. Recent transactions, reconciliation reports, mainly bank reconciliations. These are actually done in a separate area. We'll have another course or section on bank reconciliation. The trial balance, which we took a look at, which is basically the balance sheet on top of the income statement, but it's in debit and credit format. This is actually a very useful report. I use it a lot because it's cleaner and more simple than the balance sheet and income statement reports because it doesn't have these subtotals. And then transaction by detail, by account, transaction list by date. So now we have all the transactions by date, which again is just listing out all the transactions that took place. So it's going to be this big long report. And then transaction list with splits. Splits meaning it's going to give you more detail if there's more than 2 accounts affected. And then you got the more payroll reports. So I just wanted to go through those fairly quickly. So you shouldn't be overwhelmed by all these reports, because a lot of them, depending on the industry you're in, you might not use. A lot of them are redundant because you could make the reports that they give you, like comparative reports, from the standard reports, balance sheet and income statement, which we'll touch on how to do and which we've seen in more detail in prior presentations.